Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The last year hasn't just seen a surge in the number of new traders getting involved in the share market, it's also seen a boom in the popularity of ETFs, or exchange-traded funds, a fund that invests in a range of stocks, for example, across a particular sector. We've spoken about ETFs before with Chris Brycki, the CEO of online investment advisor Stockspot. Stockspot has now released research into the most popular ETFs of the last year and which ones have delivered the best and worst returns. Chris Brycki, welcome back to Fear and Greed.
Thanks, Sean.
So let's get straight into it, Chris. What was the ETF that performed best?
Well, over the last 12 months, the best performing ETF was an ETF with the code ACDC, which was
fantastic.
a battery-focused ETF, actually. So it was a thematic ETF, which are a group of ETFs that focus on quite niche themes.
Right.
And invested mainly in companies related to lithium and the making of electric vehicles and batteries for those vehicles. So within that ETF were companies like Tesla and Nissan and a few lithium miners in Australia like Pilbara Minerals.
Wow. I didn't even realize that there was an ETF that you could focus so specifically on.
It's a bit of a new thing. I mean, there's now over 200 ETFs in Australia from, when I started Stockspot, probably about 30. So like all of the big vanilla index ETFs have now been covered. And so the ones that seem to come out nowadays are all these thematic ones that tend to have good marketing stories behind them and are a little interesting. Some do very well, like this one. Some don't do as well. But yeah, they do get a lot of investor interest.
It's kind of an interesting concept because the thing about ETFs that I've always thought was attractive was that you're sort of half right and half wrong in many ways. You're kind of spreading your risk, but these sorts of ETFs are definitely very focused.
Well, that's right. I mean, I love the benefit of diversification that ETFs give you. Even within an ETF, the ASX 300 one gives you 300 companies across different sectors of the economy. So if one sector does well and one does badly, they kind of counterbalance each other. Yeah, the problem with these niche ETFs is you can get it really right or really, really wrong.
Yeah.
And it kind of tends to happen 1 year in, 1 year out. So actually last year's best performing ETF, which was, I think, a palladium ETF, actually was one of the worst 10 this year. So it tends to flip from great to poor, and you're more lucky than smart usually if you get it right.
So what were some of the other better performing ETFs this year?
This year, I mean, obviously markets from the bottom of the COVID crash last year performed quite well. So a lot of the share market focused ETFs and technology ETFs particularly did well. So there were the FANG ETF, which focused on the big US technology businesses, the NASDAQ ETF, some of these quite focused technology ETFs, because that's the sector that's performed quite well, were the other big winners over the last year.
Okay, so what about the other end? Who were the worst and why?
Well, the worst performing, again, were ones that tended to have done well the previous year. So palladium was one of them. Gold, which had a great run up into the COVID crisis, gave back some returns. I think fell by 12 or 13% over the last year. The worst of all was an ETF with the code BEAR, BEAR, because it bets on the share market falling. And obviously over the last 12 months, it's been a pretty good period for markets. So it lost 30% of value over the last year.
So ACDC was a winner and BEAR was a loser.
Yeah, that's right. I mean, they've both got 4 letters, so things are definitely changing in the ETF world. They're all more interesting niche ETFs these days that are making the headlines.
So how popular are the niche ones vis-a-vis the mainstream kind of index-hugging ETFs?
Well, the mainstream ones still take the bulk of new money. So the most popular one over the last year in terms of money coming in was still the Vanguard Australian Shares Index Fund, which is the one we've recommended for 7 years or so now, which is just a very low-cost, diversified fund. It attracted several $1 billion over the last year, but the growth rates of these more niche ETFs are pretty phenomenal. So over the last year, thematic ETFs, which are these ones that really focus on a very small sector like cloud computing, climate change, biotechnology. There's an interesting one that does investing into online gaming related companies, esports and this sort of thing. But these niche ETFs grew over the last year from $500 million in Australia to having close to $2.5 billion under management. So, almost 5 times over a year.
And these are it's all retail money?
Tends to be, particularly with these ones. I mean, they're heavily marketed to retail because they tend to launch after these are already quite embedded trends and things that people are talking about and in the newspapers. So the cycle for launching an ETF tends to follow performance. And as a result, these things do attract a lot of retail funds. Unfortunately, some don't do well and then end up shutting down because they have poor returns. And that's happened quite a bit. And I expect it will probably continue to happen going forward.
Okay, so if you're investing in an ETF, you mentioned Vanguard with low fees there. I suppose that's a very important part of the puzzle, to keep an eye on the fees.
Well, we think so. I mean, if you have a look at what's one of the biggest drivers of your long-term performance, it's the asset class that you're investing in, and fees is the second most important. So getting the right asset class is the number one thing you need to do, and making sure you're diversified across asset classes. But in a world where, particularly now, returns are quite low. So if interest rates are zero in most developed countries, then the returns you can probably expect from the share market are only 4 or 5% per year. And if you're paying 1 or 2% to a fund manager, that's a big chunk of your returns you're paying away. I mean, I think that's one of the real attractions to ETFs at the moment is people realize that returns are going to be low. So you want to be paying less to your fund manager and keeping more yourself.
Yeah, okay. Now, they've been around for a couple of decades now, ETFs. Have they picked up in popularity post-pandemic or during the pandemic and since then?
Oh, massively. So over the last year, it's been the biggest year of growth that I've seen, percentage-wise and dollar-wise. So about a year ago, we were sitting at, I think, 57 billion or so in ETFs in Australia, which is already pretty great growth since, I think, 2013, when I started looking at them, there was only 8 or 10 billion. So they had already 5 times. They just cracked $100 billion early this year. So they grew by close to 80% over 1 year. Now, some of that was markets rebounding, but actually a lot of it was new money coming into them as well.
Right. And do you know the sorts of people that are actually, we talked about retail investors, but in that market, there's everything from day traders who watch their ComSec screen all day to others who just sort of sit and forget, in a sense. Do you know what sort of money's coming in?
Well, the stats that I've seen are that actually 1 in 2 ETFs, or at least the dollars going into 1 or 2 ETFs, comes from self-managed super funds.
Right.
So that's definitely a big source of money for ETFs, which makes a lot of sense because historically self-managed super funds have struggled to get good overseas investing exposure, which ETFs do very well and at low cost, and have found it hard to diversify into other defensive assets like fixed interest and gold. So self-managed super funds, and we definitely see a lot of SMSFs using ETFs through our platform. But on the flip side, with these more high-octane ETFs that are a bit more high risk and can go well or badly, they tend to attract the day traders. So, for instance, there are some ETFs listed that are leveraged ETFs, which give you 2 or 3 times the daily return of the share market. So if you're imagining a day trader wanting to really amplify their returns and bet on whether the market's going up or down tomorrow, those sort of products are attractive to them. But they're really terrible products for a long-term investor because that leverage costs a lot of money and they tend to really perform poorly over longer periods of time.
Stay with me, Chris. We'll be back in a minute. My guest this morning is Chris Brycki, CEO of Stockspot. Looking at it more generally, and not just ETFs, but investing, when you have a market like you have at the moment, and it has hit new record highs in recent times, and you look at a bank like the Commonwealth Bank, its share price has done incredibly well recently. How do you go about finding opportunities in the markets?
Well, it's a good question, and we get it quite often. I think there's a reluctance to invest in the share market when it's hitting all-time highs. I guess people are naturally bargain hunters and they want to buy at a discount. In fact, if you have a look at the evidence of returns when you buy the market at all-time highs, it's no different if you buy markets at any other time. So I think one of the education pieces we've been doing recently with clients is that there is no difference whether you're buying the market at an all-time high or not. In fact, this year in the US, there's been 30 all-time highs already this year, and all-time highs tend to attract more all-time highs. And so our position to clients is there's no need to wait for bargains or look for bargains. Ultimately, if it's a bargain, that everyone should already know about that bargain, and it's unlikely that you have extra information that others don't have. So just diversify, spread out your money, and don't worry about where the market is relative to history, because it's not actually a useful anchor point.
The catchphrase, it's time in as opposed to timing.
Absolutely correct.
So hang around the stock market. Do you think the market at the moment is fairly valued? That's probably a nice way of putting it.
Well, the market is never fairly valued. The problem is working out whether it's undervalued or overvalued, and when it's going to revert to a different level is the hard thing. So markets can stay overvalued or undervalued for decades. And so I always question people that try and guess whether the market's overvalued or undervalued, because you're basically trying to predict, so many different variables that are just unknowns, people's behavior, macroeconomics. So is it undervalued or overvalued? I would say, depending on how you look at it, it could be either. Compared to history, if you look at sort of simple ratios, it looks expensive. But when you consider interest rates in Australia are zero and the returns from other assets relatively are very low, it looks cheap. So unfortunately, these are all the sort of considerations you need to think about. And yeah, there's market strategists out there and analysts out there trying to make predictions about the future. Our view is no one can predict the future, so just prepare for all different types of future. And the best way you can do that is by owning different asset classes that perform well or poorly in different environments. So that's why, for instance, at the moment, gold's done very badly over the last year, but we think it's an incredibly important asset to own because in certain environments where there's low interest rates and growing inflation, it will actually perform quite well, whereas other asset classes might not.
That's some of the most sensible advice I've heard for a long while, Chris. I mean, I've looked at stock markets for 30 years and I totally agree. It is really hard to get it right, particularly when you're a retail investor.
Yeah, there's an addiction to kind of predict. And I think in most areas of life, people expect that if you do more work and more research, you get better results. But counterintuitively, when it comes to investing, if you do more work, you don't get better results. And even people that spend their lives trying to analyze share markets don't outperform an index fund typically. And so markets, even though they're not perfect, they're still hard to beat. And unless you're one of the 1 in 1,000 hedge funds that have worked out a secret trick to beating the market, the trick is actually just to own the whole market.
And get advice. That's the other thing I would say to retail investors, and I appreciate day traders aren't going to do that. But if you're not a day trader, I actually think getting financial advice really matters.
Absolutely. And getting advice from someone that isn't going to put you into a product they've manufactured. And I mean, that was the reason I started my business was because unfortunately in Australia, historically at least, a lot of the advice has been really awful advice just to buy these high cost products where the person recommending those products or their employer makes a large margin, but the end investor loses out.
Hopefully the Banking Royal Commission, it hasn't stamped it out, but hopefully it's improved the situation. And certainly with the banks selling some of their financial advisory firms, maybe things will get better in the future.
I hope so as well.
Chris, thanks for talking to Fear and Greed.
My pleasure.
That was Chris Brycki, CEO of online investment advisor Stockspot. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.